Well, our next guest says that the United States has reached its 0 hour, which is when additional debt growth does not lead to any additional GDP growth. So for more on debt woes in this country and around the globe is investor Marc Faber. He's publisher of the Gloom, Boom, and Doom report. He joins us via phone from Cambodia. Good morning, good evening to you, Mr. Faber. I want to ask you,
good evening.
The idea of the United States and its credit rating no longer remaining at AAA, at top levels, has been shrugged off by the U.S. Treasury Secretary. What's your thought?
Well, personally, I wouldn't listen very much to the U.S. Treasury Secretary, especially with Tim Geithner. But that aside, the case is simply like this. If you add all the unfunded liabilities the U.S. has in terms of future liabilities arising from Medicare, Medicaid, and Social Security, then obviously if the U.S. were a corporation, it wouldn't be a AAA, but it would have bonds that are junk rated.
But how would you get out of this situation if, in fact, we are at an inflection point, at the 0 hour, as you say? I know in your latest newsletter you suggest either defaulting on debt or monetizing the debt via inflation reduction as well. Tell me how you see a way out.
Well, the way I would have done it is, first of all, I would have avoided the credit build-up, in other words, the credit bubble that occurred between year 2001 and 2007. And this occurred right under the eyes of the U.S. Federal Reserve. And the Federal Reserve, you have to ask yourself what they were smoking, because they saw that as they increased interest rates, credit growth actually accelerated. So something had to be wrong if you increase the Fed fund rate from 1% to 5.25%, and credit growth goes from an annual rate of 7% to 18% at the end of 2006. But for Mr. Bernanke, credit is not a factor in monetary policy, nor is it for Mr. Paul Krugman. That is the problem, that the cause of the crisis, which was excessive credit, was dismissed. And now it's dismissed once again, not by the private sector, which is contracting credit, actually, but it's dismissed by the government, who is piling up additional debts. As you know, the fiscal deficit this year will be roughly $1.5 trillion. Mm-hmm. And as I have maintained for years, it will not drop below $1 trillion for as far as the eye can see.
But the U.S. is still viewed as the gold standard here, particularly when you look at some of the fiscal issues in Greece, in Spain, in Portugal. I mean, when does this actually start to matter? Why is this the 0 hour now?
I disagree with you. I don't think that anyone looks at the U.S. as a gold standard, because
Stanley Fischer of Israel said that, and Treasury Secretary Geithner were quoted as having said that both over the weekend, which is what I was citing there.
Yes, exactly. But if it was the gold standard, then the price of gold would not have gone up from $251 per ounce in 2001 to now over 1,000. So very clearly, the market perceives that something is wrong in the United States. Mm-hmm. Now, the reason that bonds in the U.S. are still being bought by investors is that a lot of investors don't buy them for a 10 years holding period or a 30 years holding period, but just as a trade. And B, it's being bought by other central bankers that are not much better than Mr. Bernanke. That is the problem in the world.
I want to ask you, sir, you've also highlighted some concern about China, saying it is likely that they will disappoint this year on the economic growth front. Are you saying that there are asset bubbles that are about to burst there?
Well, very clearly, we have some sectors of the economy that have been grossly overbuilt, among them real estate. And the real estate construction cannot continue at the present pace. It's inconceivable, because they have already widespread vacancies in most of Chinese cities. So there will be a slowdown. The big question investors should ask themselves is China only going to slow down from, say, a growth rate of around 9% to maybe 3 to 6%, or is it going to crash? Now, looking at the market action of raw materials such as copper, down already 18% from the high, aluminum down 16%, lead down 25%, zinc 24% down. I get the impression that actually China's demand for raw materials is going to slow down very considerably, and it will have a deep impact on the rest of Asia.
All right. Thank you so much, Marc Faber, joining us this morning from Asia via telephone from Cambodia.